Hey everybody, Larry Berman here, and here's what's on my radar this week. Well, after last week's late jump on, I guess, Powell not being as dovish as expected, we've entirely reversed, the jump from last week and then some. In fact, we went out at the week pretty close to a 3-week low. Going back to November, remember mid-November, a lot of expectations, the Fed pause. So this week we're looking at busy economic calendar, and obviously highlighted by the Fed meeting, CPI, retail sales, based on Friday's PPI report coming in a little bit hotter than expected. Expectations shifting towards just a little bit. It's evident in this week's price action, being a little bit more difficult, for the Fed to do their job. So, 50 basis points for the Fed is almost certain. There will be a lot of language around slowing the pace, measured. We've got data dependency. Question is, will the market see that as a reason to rally, or now start seeing that as a reason that the Fed sees the economy weakening, real reason? And not that they're going to be able to ease, because they won't until inflation drops significantly below 3%, which wouldn't be expected just based on the simple mathematics of things until at least the third quarter. So growing expectation throughout the 2023, I imagine, as we get closer to Jackson Hole, and the Fed conference, typically at the end of August, going to see more and more Fed speak, I think, around we're going to have to get used to accepting slightly higher inflation. Again, it's just going to complicate the picture for the markets. Those looking for a risk-on rally here, I think, for the most part, are misguided. Also, highlighting this week and what we noticed in the bond market, we've got a 3-year, a 7-year, and a 30-year auction next week. And the auction sizes are starting to get bigger. The Feds, with their QT, is starting to get less. So, what was a strong rally in the bond market in the last couple of weeks, supporting equities, what it looked like in the past couple of days here, we had got back below this 350 level. Everyone started to call it bullish. We've said for a while it's more of a technical squeeze, getting bond shorts covering. And in this case, what it looks like is we failed that rally, and we're going to see a backup now. The higher yields get into supply, the more likelihood we're going to see equity markets weaken. The bull and bear pick of the week. It was really hard to find something that was, bullish. 2 weeks ago, we talked about being cautious on energy. We can see that the charts are rolling over here again as we get closer to the idea of a recession. You look at where else you want to be cautious here in terms of the financials. Starting to roll over again, top end of the range failure. So, financials, energy starting to roll over, the value trade, the growth names aren't performing, spells more broad market weakness than we would otherwise like to see. So where do you look for something bullish? Well, unkind words out of Mitch McConnell this week has taken the marijuana play a little bit off the table. And you can see in the past few days, hopes for banking reform that was part of this move and a little bit of a breakout here was doused with cold water by Mitch McConnell. But I do think there's bipartisan support here, and this is a longer-term base, developing. And those people with a horizon out a couple of years, this is one of the cheapest sectors out there. Have a great week, everyone.